Yes, so good evening, everyone. Am I audible? Please type in the comment box, chat box, if I'm audible. Yes, okay, fine. Yeah, so good evening, everyone. So last year also we had a startup jargon webinar series, which we had like kind of for almost 6, 7 sessions. So in continuation to that, this year we are again starting the session. This time it will be more extensive, more diving deep into smaller topics, which would be helpful for a founder to understand how the ecosystem actually works and what they should be careful when they are building their business model. Okay, so this is going to be a like kind of early stage founder friendly, or maybe like kind of an idea stage founder friendly session. I'll be like kind of helping you with all the critical terminologies. I'll be helping you with all the terms that you need to know. It as the name suggests, it's going to burst all the jargons associated with startups. Okay, so yeah, I can raise my voice, check this. Everybody can hear me, no? It's audible, no? Okay, fine. Yeah, so the first session, this time, the first session, I'm covering a lot of things in this session. It would be mostly like kind of touching upon major areas regarding investor-ready startups, like what all things an investor would be looking in a startup. And maybe in the ongoing sessions, we can have detailed one sessions on each small topics. Okay. So the topic today is investor-ready startups, financial secrets behind successful fundraising. Okay. So the agenda for today's session is what investors actually look for in a startup, breaking few jargons like few terminologies associated with startups, which you need to know. Then basics of unit economics, what is unit economics, and a few numbers uh, in understanding the unit economics or how to build a unit economics. I've done this based on three models: on a one on a SaaS model, one on a D2C model, and one on a marketplace model. Okay. Then building a trustworthy financial model or a business plan. That is something what is being covered. Then valuation and dilution. I would be explaining the core concepts of valuation. What is dilution? What is pre-money valuation? What is post-money valuation, etc. Then data room and governance hygiene. This is again like regarding virtual data room, how you should be maintaining your documents and what all hygiene you should be following with regard to the compliances. Then on top of that, I'll be giving you a 30-day readiness checklist, which you can practice on your own for your startup. And once the session is over, for all the participants, I'll be sharing a sample business model Excel template and also the instruction kit how to fill it and a KPI dashboard created on Excel. Okay, so we'll quickly jump into one by one. Okay, so what investors really buy? So firstly, like kind of we'll look at this point. So typically there is a concept among startups that the investors put money into the idea. So it is correct in a way that the investors look a lot for the idea, but they generally buy risk reduced stories. So if your idea is good, just because your idea is good, you don't get an investment. The risk should be reduced for an investor to put in money. So an investor would be really looking for risk reduced stories. Okay, so what are the risk areas the investors would be looking? That is something what we need to understand first. Okay, so the first is the market risk. So when I say market risk, whether there is a proper market available for the product or service that you are selling, like whether there is a proper for example, the product that you're building can only be purchased by say 10 people. 10 people is the maximum market for that product, so there the risk is high. So once these 10 people buy the product or service, then the business is not going to survive. So the investor look for whether the market is actually there for the product or service or the solution that you're building. So that is what is called the market risk. Whether the market is really big, whether the market is really available for the product to scale, that is the primary thing. Then the second thing is the product risk. The product risk is the solution that you're offering, whether it is really working. whether it is solving the actual problem, whether the use case is, the use case is genuinely valid. So these are the things an investor would be looking from the purview of a product. Okay. So product risk is something which is kind of understanding the risk associated with the product, the solution that you are offering. Then the third thing is the team risk. Whether the team who is behind this startup is really capable of pulling this off, whether they have got the bandwidth to pull this off, whether they have got the expertise to pull this off, whether they have got previous experience in building a similar model and scaling it up. So there are few things like this which an investor would be looking, and that is why the next risk element is team. Okay. Then is the finance. When I say finance, whether the business can be done profitably. Like when you're scaling from say 1x to 10x, whether the cost will also jump from 1x to 10x, whether the 1x to 10x can be done at lower than 10x the cost growth. That is the real this behind building a profitable business. So whether the finance and all numbers are supporting the business that you're building or the solution that you're offering. Then we have the governance risk, whether the governance authorities, the government or the Ministry of Corporate Affairs or whoever it is, are they going to come behind us if we start this business? Are we doing a legal business? Are we doing a legit business? So is there any governance risk associated with the business that we are building? So the main five risks that I have listed is: first is the market risk, second is the product risk, third is the team risk, fourth is the finance risk, and the fifth is the governance risk. Okay. Then we have key filters also, what the investors would be filtering or what the investors would be checking in your model to understand how the risk is being mitigated. The first thing is traction. So traction is like kind of how many users you have currently or what is the revenue that you are generating currently. Traction is the progress that you have built in your business till date. Okay. So whether the users are really using your product or the user growth is increasing or those are the numbers that an investor would be checking when they check the traction. So from that they can understand like whether the product risk is mitigated because people are using your product properly. Then comes the margins. So when I say margins, the investor would be checking on a per unit level whether there is a proper margin for the product or the solution that you're offering. When I say per unit level, for example, you are selling a software. Maybe the subscription price is say 1,000 rupees per month. So on while selling it for 1,000 rupees per month, whether you are making any profit, what is the margin that you are going to generate from selling this software? That is called margins. So the investor would be looking at your current numbers and or the current business plan and understanding whether the margins are there. Margins are really available. Okay. Then the third aspect is the scalability factor. Whether this business model can be scaled to a 10x factor or say 5x or whatever it is. Like can this business be scaled? Or will it reach a stagnant point after scaling a bit? So scalability is another part which the investors would be filtering. Then we have the compliance part. So the compliance part would be like investors would be checking whether we have all the licenses in place, whether we have all the approvals from the government authorities regarding starting this business. Okay. So I'll repeat the key filters once again. First is the traction, then we have the margins, then we have the scalability, and then we have the compliance. So repeating the slide once again, the investors really buy risk-reduced stories. More than idea, they want the business to be risk-free. So the risk areas that they would be focusing would be market risk, product risk, team risk, finance risk, and governance risk. Then we have the key filters, what the investors would be checking. We have the traction, we have margins, we have scalability, and we have compliance. Okay. I'm moving to the next slide. So funding journey. It's important to understand what is the funding journey for a startup. So if you look at the image I've presented here, so we have a pre-seed stage, we have a seed stage, we have a Series A stage. It can go to Series B up to what? Series X, Series Y. You can put n number of alphabets there, and you can continue raising funds, or maybe if you'll go for an IPO. Okay, so but primarily I'm focusing on the three stages. One is the pre-seed, seed, and Series A. So when I say pre-seed, it is the idea stage or prototype stage where you typically raise money from an angel investor. Okay. Then we have the seed stage. Seed stage is where you have started building early traction. When I say early traction, you have started generating early revenue. You have got few clients or few customers, and you're planning to raise. You're planning to scale. At this point, the investors would be mostly venture capital funds and maybe some angel investors also. Okay. Then we have the series A or the growth stage. These are the series round. This is after you have enough of traction and your product has shown a product market fit. Then we have the series A, series B stage coming, which is a growth stage fund. Here also the fund would be put in by like kind of big VCs and private equity firms. Okay. And then up to IPO, like kind of again, we list the company in the stock market and raise money from the public. Okay, so the funding journey I have segregated like pre-seed, seed, series A, series B, series C, D, like that we can put even you might have seen in few startups they have numbered the series like series B1, series B2, series B3 because they want to raise the series C at a larger valuation or something. So they do bridge rounds in between and name it B1, B2, B3 like that. So this naming doesn't have any hard and fast rule. It's up to the startup how they name the series. Okay, so it's idea or prototype stage is the pre-seed stage where angels typically put in money. Then we have the seed stage where early traction is there and the company is racing to scale. At this point, angel networks and VCs can invest. Then we have the series A stage or series B or like the series stage growth stage investment wherein high-end VCs and private equity firms will be putting in money and then finally we'll go for an IPO. Okay. Why I haven't mentioned IPO here is because IPO may not be like kind of an end journey for every startup. Few startups may run the business as a profitable venture after raising Series A and Series B. They may not be going for an IPO. Okay. Then we have mentioned what are the types of instruments typically available. We have equity. Equity is giving your equity capital or the share capital directly to the investors. Then we have convertible preference shares, CCPS, or convertible debentures. These are instruments which have preference over equity shares for the investors. And this CCPS or CCD would be the typical instrument that an investor puts in most of the fundraising deals. Why? Because it has a preference over equity share. In case your company is being liquidated after a point of time, you're not able to scale. At that point of time, when you're winding up the company and you're selling off all the assets, the investor want to recover their money. So they should have preference over the founders. So they generally prefer CCPS or CCD. Then we have the SAFE or convertible notes. SAFE is a concept very popular in US. In India, the version which is available is convertible note. Convertible note is applicable only for startups. So that's also much similar to like kind of CCPS and CCD, but the compliances are not that critical as compared to CCPS or CCD. But the only limitation which I have found in practical scenario is that for every convertible note, the minimum investment amount should be 25 lakh. When I say 25 lakh, in every tranche it should be 25 lakh. So for example, if you are raising 1 crore in convertible note and the investor puts in 30 lakh, 30 lakh, 30 lakh, the fourth tranche of 10 lakh he cannot put using convertible note. Because in convertible note, every tranche has to be 25 lakh. And typically in early stage deal, what happens is maybe like kind of angel investors would be putting in money in lots of say 5 lakhs or 10 lakhs and they'll be pooling as a network and putting 2 crore into the company. So the minimum check size would be what 5 lakh or 10 lakh. So in many cases, it's not practically possible to do convertible note. And most of the VC firms generally prefer CCPS or CCD over equity. Okay. And one more thing to understand is that money being raised is not for meeting the expense, it's to reach your milestones. So you should be having business milestones which you are communicating with the investors and which you have, I mean, you have curated for yourself also to kind of develop. Okay. I mean, to achieve. So money is being raised for achieving the milestones and not for meeting the expenses. Okay. So generally the funding journey, I'll just repeat pre-seed, seed, and then we have series stage. Then types of instruments, equity, CCPS or CCD, which is convertible preference share or convertible debentures. Then we have safe notes or convertible notes. Also, always remember money is for attaining the milestones and not meeting the expenses. Okay. I have a couple of questions. Can you please elaborate on SAFE and CCPS? So, Dipesh, like in the interest of time today, I'll be just touching upon these areas. We'll be having a separate session on these instruments later. Can LLP raise seed funds? See, LLPs typically the investors don't prefer putting money in LLP. They would always want you to have a private limited company to put the money, because that is the most safest way and it's the most, the better way to structure a deal. So that's why typically LLPs don't, investors, VC firms don't invest money, but definitely you can raise fund in LLP from individuals. Okay. Hope I answered your question, Sudhakar. So I'm moving to the next slide. So now we have a few jargons associated with startups. I'll be just explaining these jargons to you. So firstly, the common term is runway. Runway is months before you run out of cash. So this is a general term which we use in investment language. Even when we pitch to investors, investors typically ask how much months of runway do you have. So runway is nothing but, for example, your monthly expense is say 10 lakh rupees and you have 1 crore rupees in your bank. So, how much month you will be able to survive? So, it is 1 crore divided by 10 lakh, 10 months. So, that is called the runway. Runway is the months before you run out of cash. Okay. So, it's ideal always to raise funds when you have a runway of around 6 to 9 months, because the fundraising deal would take around 6 to 9 months to close in in a majority case. In a best case, only it will get closed in less than 6 months. Okay. Then we have burn rate. Burn rate is the monthly cash outflow. In the previous example, what I told you, are spending 10 lakhs per month, your burn rate is 10 lakh. Then we have CAC. CAC is cost to acquire a customer or customer acquisition cost. It's nothing but the overall marketing spend divided by the number of customers you have acquired. Okay. Then we have LTV, lifetime value of a customer. So when I say lifetime value of a customer, it's like you onboard a customer. For example, it's a monthly recurring revenue. And on an average, your customer is, the monthly fee is say 10,000 rupees. And on an average, your customer is staying in your website or in your platform for say 5 months. So 5 months they are staying and they are giving you 10,000 rupees per month. So 5 into 10,000, 50,000 is the lifetime value of your customer. Okay. So that is lifetime value of a customer is LTV. Then we have payback period. Payback period is time to recover the customer acquisition cost. So in the previous example where I told it's the 50,000 is the 50,000 is the overall cost. The lifetime value of a customer. For example, the cost you require to acquire this customer is say 20,000 rupees. Okay. So you want to spend 20,000 to earn this customer. Then your payback period is 50,000 divided by 20,000. It is 2.5 months. So in 2.5 months, you will be recovering the cost that you have incurred from this customer. Okay. Then we have cap table. Cap table is nothing but it's the full form, short form of capitalization table. It shows like who owns what percentage of the company. So who all are the investors in the company? Who what percentage do they own? What percentage does the founders own? What percentage does the employees own? So it's a cap table. It's the ownership breakup. Then we have ESOP pool. It's the employee stock option pool. So it's actually a pool created for shares to be issued to the employees based on few milestones and few things that they achieve in their employment period. So it's like kind of creating a pool out of your existing capital to be allocated to the employees in future. All these things I'll be taking separate sessions in the coming up sessions. Okay. Then we have dilution. Dilution is the reduction in percentage of ownership when new shares are issued. For example, a new investor comes in and we have heard like investor A takes 10% of this company by putting in 1 crore. So 10% is the dilution for the company. So it's from the company's perspective. So dilution is nothing but the reduction in percentage of ownership for the company or for the founders when a new investor comes in or when new shares are issued. Then we have MVPs, minimum viable product is like most of you might be knowing. It's a workable model of what you're building. Like you have built a product or solution, like whether in a minimum viable state, like it may not be a foolproof or if you're building, for example, if you're building a website, okay, it would be the workable model. The UI UX part may not be coming in there. It's just to understand whether this product is going to work. So that is what is called MVP. Okay. So we discussed what is runway. Runway is the months before you run out of cash. Then we discussed burn rate. Burn rate, it's monthly cash outflow. Then we discuss CAC, customer acquisition cost or cost to acquire a customer. Then LTV, lifetime value of a customer. Payback period, time to recover CAC. It's nothing but LTV divided by CAC. Cap table, it's the ownership breakup or capitalization table. What percentage of the company is being owned by each person? ESOP pool is the reserved shares for employees. It's a pool set apart for issuing shares to employees of the company. Then we have dilution, reduction in percentage of ownership of the company when new investors or new shares are issued. Then we have MVP, which is a minimum viable product. A few questions in the chat box. So runway is net outflow, revenue minus outflow or gross monthly. So runway is actually money in the bank divided by net outflow. So how much months you are going to last. So it's a net outflow, Jagdish. Then can LLP be formed with ESOP pool? In LLP, ESOP thing don't work actually. ESOP is available only in uh, private limited companies. It doesn't work in LLP. In LLP, you will have to structure it in some other way. Okay, so I'll just move to the next slide. Then few basics of unit economics. I have taken a SaaS example, a D2C example, and a marketplace example. So in SaaS example, so R2 is nothing but average revenue per unit or average revenue per user. So suppose that is 1,000 rupees. CAC again we have discussed customer acquisition cost, that is rupees 3,000 per customer. Then we have a gross margin of 80%. Okay. So if gross margin is 80%, on the ARPU of 1,000, so ARPU, first one, ARPU of 1,000, 80%, we are generating 800 rupees as gross margin from one customer. And the CAC for this customer is 3,000. So the payback period is going to be 3.75 months. Okay. Before that, like unit economics is nothing but breaking your P&L into a unit based model on a per unit level. For example, you might be doing crores of revenue, but your per user revenue is say what 1,000 rupees. So you're building your P&L in a making the investor understand like for a 1,000 rupee earning customer, what is your spend? Okay. So that is a SaaS example. So SaaS it's like I mean the monthly subscription fee kind of thing. Then we have a D2C example where AOV is the average order value. It's 1,200. The direct costs are or the variable costs are say 950 rupees. Then the contributory margin is what 250 rupees. That's a D2C example. I'm just using few terminologies associated with these things. All these things would be covered in the upcoming sessions. Then we have a marketplace example where GMV is gross merchandise value. So you are here, you are a marketplace, not you are selling on a marketplace, you are a marketplace. So the GMV is 10 lakh rupees. Take rate is 12%. Take rate is the commission that you get. For example, in Swiggy and Zomato, if you are listing for Swiggy and Zomato, the revenue is 20% or 30% of the sale that you make. Okay. So that is a take rate for Swiggy and Zomato. Okay. So in this GMV model, 10 lakh is the GMV. Take rate is what 12%. So the revenue is 1,20,000 for the marketplace. Operating costs are 40,000 rupees. So the contributory margin becomes 80,000. That is 67%. Then the customer acquisition cost is rupees 200 and there are 500 users. So the overall customer acquisition cost becomes 1 lakh rupees. So the net contribution is going to be 80,000 minus 1 lakh, which is going to be minus 20,000. Okay. So what does an investor look in the unit economics is nothing but fast recovery, strong margins and scalable model. If these three metrics are there, like it should ideally work for an investor. Okay. Yeah. So I'll just move to the next slide. So this is nothing but a lean six-sheet financial model. So this is just an idea on how to create your own financial model. Basically, when you're creating a financial model, there should be this six sheets, or ideally, these six sheets are enough in the Excel template that you're making or sending to the investor. Why I'm focusing on this lean six-sheet model is because this would be easily understandable for an investor. Like they can kind of review it and understand it in 10 minutes. And if they were to audit this, it won't take more than 30 minutes for them to audit and kind of ensure the genuineness and all those things. Okay. So the first sheet would be assumptions, key drivers, like what is going to drive your business. Like when you're selling, say, 5 products, what is the revenue that you're going to generate? So, like I told in the beginning of the session, I'll be sending a template. You can use that, and we'll be having a separate session definitely on the Lean Six Street financial model. Then revenue build, how your revenue is going to be coming, what all are the products or what all are the channels. For example, you may be selling on an e-commerce website, you may be selling on an offline store. For example, you are a beauty product, you have your own website, you are selling on Nika, you are selling in the stores also. So there are 3 channels, and maybe like kind of you have a distribution partnership with somebody else also, so that can be another channel. So what is the revenue going to be coming from these channels? Then we have the cost build. What is the fixed cost versus what are the variable cost? Okay, that everybody knows. Like, fixed cost would be your rent, salary, and all those things. Variable cost would be the packing charges, transportation cost, whatever is associated with the production. Then we have the P&L. P&L should be on a monthly basis. Month on month, P&L should be given in the six-sheet financial model. Then we have the cash flow runway projections, like what is going to be the cash flow in each month. So one thing you need to understand the difference between P&L and cash flow is that, see, P&L shows whether your business is in profit. Cash flow shows whether you have cash in your business. Okay. For example, you do a business and you make, say, 10 lakh rupees profit as per the P&L. But the cash flow may be negative because of the 10 lakh rupees you made profit, a sale of 50 lakhs is yet to be received. I mean, the money is yet to be received from the customer. So what happens is, like, you may be running in negative 40 lakhs. Okay. So that is why we need to prepare cash flow, like how we are going to spend the money and how much balance you will be having. Then we have hiring plan. It is linked to milestone. At what point we should be hiring each person. For example, you are building a tech company, the primary focus may be on building the product, and at a later point you may need to have, once the sales kickstart, you may need to have a salesperson. After some point, when the scale reaches a level, you may need to have a CMO, a chief marketing officer. So these are the things that you need to verify and do. Okay, so what all are the 6 sheets? I'll just tell. One is the assumption sheet, then we have the revenue build sheet, we have the cost build sheet, we have the P&L sheet, we have the cash flow sheet, and the hiring plan sheet. Okay. So I'll share the template, then it will be more clear to you, and we'll have a separate session on the Lean Six Sheet financial model as well. Okay. Yeah, I'll be sharing the Excel to everybody over mail. Don't worry about that. Okay, and few metrics that matter. Again, I'm taking the SaaS model, D2C model, and marketplace model as example. In SaaS model, few key metrics that typically matter is MRR. MRR is monthly recurring revenue. For example, you are a software company, uh, you have, say, 1,000 users, and you are charging, say, 1,000 rupees per 1,000 users. So it's 1,000 into 1,000, 10 lakh. 10 lakh is your monthly recurring revenue. Okay. Then we have retention. So how much percentage of your customer is being retained in a span of, say, 1 year? What is the percentage of retention? Then we have the CAC payback, which we already discussed. How much month you are able to make the payback for the customer acquisition cost. Okay. Then in the D2C model, we have the contribution margin. Again, contribution margin is nothing but sales minus variable cost. Okay. Then we have repeat orders. How many repeat orders we are having from different customers. So that is another metrics the investors would be interested to know, because it's very important that you onboard new customers, and it is equally important or more important that your existing customers buy more and more products from your company. Okay. Then we have the marketplace model. In the marketplace model, we have GMV, gross merchandise value, which I told. Then we have the take rate. Take rate is nothing but what take rate is the percentage that you charge from the sellers in your platform. Okay. So here you are the marketplace. Then we have liquidity. Liquidity is the number of buyers and number of sellers. So if the number of buyers are less and buyers are less, and the number of sellers are more, then the model is not going to work. So when you're onboarding sellers in your platform, it should be in that manner. Okay. Then pick 3 to 4 key numbers that directly show traction, profitability, and scalability. Simplicity builds trust. Okay. So these are the few metrics that matter. Then valuation and dilution. So again, valuation I have classified into two. One is the pre-money valuation and the other one is the post-money valuation. So pre-money valuation is the value of a company at this point. What is the current value of a company? That is called the pre-money valuation of the company. Post-money valuation is nothing but the value of a company after an investment. Okay. So the formula for post-money valuation, it is pre-money valuation plus investment amount. For example, the current value of a company is 10 crore and you are raising 2 crore investment now. The post-money valuation of the company is going to be 10 crore plus 2 crore, which is going to be 12 crore. Okay. I hope it is clear. So post-money valuation is nothing but pre-money valuation plus investment amount. Now, whenever I explain this slide, the typical question is how to determine pre-money valuation. Those things we will be taking in the coming up sessions because I don't want to focus on that thing now. But just for you to understand, like what is pre-money valuation, post-money valuation. Pre-money valuation is the value of the company at this point of time, and post-money valuation is the value of a company after investment. Okay, so post-money valuation is equal to pre-money valuation plus investment amount. Then we have percentage of dilution. Percentage of dilution is investment amount divided by post-money valuation. In the example, what we told just now, it's 2 crore divided by what? 12 crore. Because 10 crore plus 12 crore, that's the post-money valuation. 2 crore divided by 12 crore, 16.67% is the percentage of dilution. Okay. I hope this is also clear. I'll move to the next slide. Okay, now data room and hygiene. So data room is nothing but it's an online folder where you actually keep all the records of the company in a proper, neat, organized manner. And each time there is an update in the document, that also you keep on updating there. Okay, why you need to maintain a data room is because this would be actually helping you in a helping you so much in during your due diligence. Okay, so if you look at a fundraising deal of 3 to 6 months, or so say 6 months, a fundraising deal takes 6 months of time. In that, at least 3 months would be taken by the DD. When I say DD, it's due diligence. Okay. So, in order to reduce the overall fundraising time, what you need to do is like you need to complete the DD in a shorter period. So, for a DD to happen in a shorter period, what you need to have is you need to have a proper data room and records in your records with you handy whenever the chartered accountant or the consultant who is doing the DD asks you. Okay, so it's important to maintain a data room and update it on the go, like very, very, very important. Okay. So different folders that can be in a data room would be one would be the company incorporation documents and the major agreements that can be in a separate folder. Then we can have the financials of the company where the P&L should be there. GST and TDS filing records are maintained. And when I say clean financials here, each year when you do the audit and you have the signed financials, update it in the folder. And if you have a P&L MIS report for every month, update it each month there. Whenever you have a GST or TDS filing happening, update it each month there. So you keep it in a proper manner. Then you have the bank statements, contracts, and MIS. Again, very important. Upload the bank statements each month. Whenever you sign a new contract with a vendor, upload it there. What all MIS you are preparing, upload it there in the folder in a real-time basis. Then governance, like regarding your company maintenance, like board meeting minutes, resolutions, compliance trackers, all those things should also be there in place. Okay. Detailed DD template, I mean data room template, I will be discussing in the upcoming sessions. Okay. And again, like I told, clarity is equal to faster due diligence. Faster due diligence means the faster the fundraising is going to happen. So again, data room and hygiene, company incorporation docs and agreement can be in one place. Financials, P&L, your taxation, compliance, everything can be in another place. Bank statements, contracts, and MIS can be in one place. Governance, board meetings, resolutions, compliance tracker, everything can be in one place. Okay. Okay, so I'm just giving you a quick exercise in between. So, for example, the cash in the bank is, I mean, 90 lakh rupees. Okay, the burn is 50 lakh rupees per month. So, like I told, the runway is going to be 6 months. It is nothing but 90 lakh divided by 50 lakh. In 6 months, you'll be exhausting all your money. How to extend the 9 months? How to extend the 6 months runway to 9 months without new funds? Can somebody give me some answers in the chat box? Because Suraj has told reduce burn by 5 lakh. Anyone else? Any other answer? Okay, like Suraj told, like reducing the burn is obviously one way how you can, I mean, you can improve the runway or you can increase the runway to 9 months. But practically, it may not be possible always to reduce the burn. Reducing the burn is the most important thing, like Suraj told. But on top of that, what you can do is there should be ways to increase your margin. By increasing your margin, you can increase your runway. And third thing is you need to speed up the collections. For example, you are giving 45 days credit to your, customers. If you bring that down to 30 days, you'll be having more cash in the bank. And when you have more cash in the bank, your sales cycle would improve. So definitely, like reducing the cash burn is one option. You can always increase the margins bit by a bit, keeping in mind the competitor pricing and the how much the market is willing to pay. And by increasing the, reducing the time of collection or speeding the collection. Okay, these are few methods which you can use to increase the runway. Okay, yeah, Jagdish is also given answer. Ashish, yeah, correct, correct. Cool. So I'll just move to the next slide. So yeah, so this is some exercise that I want to uh, give you, the 30-day investor readiness checklist. So if at all you are interested and you want to kind of take your business ahead, this is a 30-day investor readiness checklist. Like firstly, you define what all are going to be your milestones and how much fund you require to attain these milestones. Okay. Then you build the six street model, the lean 6 street model, which I've already told. I'll share the template with you. Also, I'll be sharing this PPT also with everyone. Okay. Then prepare KPI dashboard. KPI means key performance indicator, like the metrics we told, no? Those can be KPIs. Prepare KPI dashboard on a monthly basis. Then clean your cap table and ESOP pool. So if your cap table is messed up, for example, there are like kind of your cousin's friend who came in at an early stage who is not with you now, so you need to like kind of avoid those people. So you need to clean up your cap table. All are there in the business only need to be there in the cap table. And if you don't have an ESOP pool currently, like try to structure like what is an ideal ESOP pool, how much ESOPs or how much shares you will have to or you will be able to give your employees. Structure that. Then assemble version one data room. With whatever limited knowledge you have or whatever understanding you have, try to build a data room on your own. On top of that, like we can develop it in a much more better way. Then start MIS and governance rhythm. Like I said, like you start building an MIS, create reports on a periodic manner, then focus on your governance as well. Like have a compliance tracker, maintain or ensure that your compliances are being filed properly on time. Ensure these things. Then upload all the filings and documents also in the data room along with that. So, firstly, define milestones and what is the fund required to attain these milestones. Build the lean 6 sheet model. Prepare KPI dashboard monthly. Clean your cap table and ESOP pool. Assemble version one of your data room. Start MIS and governance rhythm. Okay. KPI dashboard, I would be sharing the format. You can see. So KPI dashboard is nothing but Jagdish. It's the metrics that we told in the earlier slide. We were discussing about few metrics, no MRR, payback, CAC, those things. Okay. So fundraising is a byproduct of disciplined financial management, simple numbers, transparent story, and building investor trust. Okay. So that is about the intro session. So now it's your turn. If you at all you have any question, you can raise or you can put a comment in the chat box. We will unmute you and you can ask your questions.
Uh, Hello.
Yeah. Hello.
Hi,
Hello.
Abhijit. Hi, this is Dipesh here.
Yeah.
Uh, I think very insightful session, Abhijit,
Thank
practically,
you.
but obviously we will need to dig deep and understand few aspects.
Yeah.
Two, three quick question. One is you said about the ESOP pool.
Hmm.
So ESOP pool, we cannot create an LLP initially with the ESOP pool itself, you said, right?
Yeah. In LLP, the concept of ESOP is not there.
Not applicable. But in a private limited, can we create a pool? Let's say four people are contributing in the private limited. Those are just the ESOP pool contribution that happens, and based on milestone that the shares get allotted.
Yeah.
Is that
Correct.
possible?
Yes. Yes. So typically in an ESOP pool, for
Yeah.
example, if you look at a company, 90%, so me and your partners, okay.
Yeah.
So Abhijit is owning 45%, Deepesh is owning 45%, 10% is
Okay.
ESOP pool. So if
Okay.
you look at the balance sheet of the company, it would be 50-50 between me and you. That's 10% we have not allocated to the employees. We have
Okay.
set apart only. In future,
Okay.
we may allocate it, but we have just kept it apart. By because once the investor comes in, for example, say Dinesh comes in as an investor. Okay,
Hmm.
he is owning 20% now. So it's
Yeah.
what 40-40-20. Okay.
Right.
And
Right.
then you are creating 10% ESOP pool means Dinesh will also have to reduce his stake in the company. He would be okay
Okay.
to reduce the stake in the company if a new investor is coming because the value of the company would be going up there. But just to create
Mhm.
ESOP pool, he may not be that interested. That is why you have to structure the ESOP pool well in advance before the fundraising thing.
So I may be sounding stupid, but a simple question is: let's say if you're contributing 100 rupees, for example, we are two people, we are contributing 100 rupees. So can we mark that 100 rupees itself entirely for the ESOP pool, and then we, based on milestone, start allocating to the shareholders, to the
Uh,
holders?
so it typically is not like that, Dipesh. So 100 rupees each, if you contribute 200 rupees as a capital. So
Yeah.
that shares is being owned by you only. You are not going to give your shares to anyone.
Okay.
That is a basic wrong notion people have, even with regard to investment also. So whenever you
Okay.
are raising a fund and you are giving 10% of the company to an investor, it is
Hmm.
not that you are giving 10% from your ownership to the investor. You are
Okay.
issuing a
Okay.
fresh set of shares to the investor, thereby your holding in the company reduces by 10%. That is what is happening. Similarly,
Right.
SOP
Right.
also, it is a fresh set of shares that you are going to give to the employees.
Hmm. Hmm, hmm, hmm.
Yeah.
Okay. Got it. Second question I had about on the CCPS.
Huh.
So CCPS is a interest bearing security or a dividend paying security, right?
Yeah.
Instrument. So can it be marked as zero payment at zero
Uh,
rate of interest,
yes,
or
in
very
most of
nominal,
the
or 0.1
yes,
percent kind of?
in most of the deals I have worked in, it is like 0.0001 percentage CCPS like that.
Okay, and that is always beneficial from the investor's point of view because of the liquidation. If the company goes into liquidation, that's the only
Yes, yes.
benefit, right?
Preference, they get preference over
They get the preference,
the equity owners.
right?
Yeah.
And third,
And
final
also, like,
question I had.
it also helps in deferring your valuation also. Those things I'll cover up in the upcoming session. For example, currently you're not aware,
Yeah,
not in a stage to determine the value of the company. It's a very early
right.
stage company.
Mhm.
So maybe like kind of after you attain some traction, they will convert it to equity so that at that time the valuation can be different. So there are few structuring flexibilities also for CCPs and CCDs.
Okay, okay.
Yeah.
And third, final question from my side is that how many sessions, and is there any plan that you prepared in terms of when all will be taking these follow-on sessions?
Nothing as such, but currently planning to have at least on a bi-weekly basis, like 2 sessions every month. So we have a
Okay,
WhatsApp group, uh,
okay,
like where we update about the sessions and in all the social media, like LinkedIn and everywhere. I post about the sessions. So if you can, we already have your contact number. We'll add you to the WhatsApp group. If at all you are not
Okay.
interested in being the WhatsApp group, you can leave at any time. But that's
Yeah.
where typically we make all the announcements.
But you do add, or if you can give us the number, then we'll ping on that if you can add us.
Yeah, yes. So by the end of this session, Dinesh would be sharing the contact. See, already they have shared the numbers and
Yeah, I think they'll
to
share it.
the WhatsApp
Yes,
group.
yes.
Yeah.
Okay, right. Thank you, Abhijit. Thank you so much.
Thank you. Yeah, anyone else have any question? Ashish has asked a question, what percentage ESOP pool is fair and investor friendly? So typically I've seen companies do up to 10%. In few cases I've seen 15% also, but the median range would be 10%, I would say. So, and there are companies who does 5% also, but median would be 10%. So Jagdish, regarding CCPS and CCD, I'll be having a detailed session on that because we have to go a bit more deeper into a few topics before that. That's why. And KPI dashboard is like I told, key performance indicator dashboard. It's KPI is key performance indicator. It's like key metrics, a dashboard showing the key metrics of the company. Just for you to track the key metrics, how your business is progressing, and these things you can share with the investors as well. Okay. Yeah, any more questions? Anyone have any more questions? Yeah, I'll be sharing that via mail. I'll be sharing the PPT and sample Excel. This one. So, Dibesh, like if you are asking to me, I'm a chartered accountant. I'm into practice. I help startups in their compliance, investment readiness, fundraising, and all those things. Uh, Not much into the traditional CA things. Started off as a traditional CA, but focusing more on startups and SMEs. If there are no more questions, we'll wind up. Do you offer fraction? Yeah, we do, Ashish. We do. Fractional CFO is and virtual CFO is something what we typically do for all the clients. Like I do a lot of DD for a lot of, not a lot of few VCs. So thereby I have got experience. I have done more than 50 plus due diligence deals. So I know what investors typically look for. So based on that, I started offering the services to my client and all. So my service offerings would be Jagdish, I do the virtual CFO thing. I do a bit of fundraising. Again, fundraising, I don't take too much number of companies. We work more on a project basis, and there should be a lot of. I have to be personally present on all the investor calls as well. So we have bandwidth issues. So we take only very limited number of deals. So fundraising is something what we do. We do fractional CFO service. We do the secretarial part, company setup thing, structuring the company, shareholders agreement, everything. Okay. You can connect me personally. I've given Dinesh and Richard's number. Like you can connect with them, and then you can schedule a meeting with me. They'll share the link to connect with me. Yeah, they're connecting POC. Dinesh, if you can, they've already shared the message. Yes. So Dinesh has shared the message once more. You can either reach out to Richa or you can reach out to Dinesh. Okay. Yeah. So I think we can wind up the session, no? Yes. So thank you everyone. Thank you for joining the first session of Startup Jargon Buster. So going forward, we'll be we'll be digging deeper into separate sessions, and in that sessions, you'll be getting more clarity on how the things are working, and I'll try to make it more in a more simplified manner. Okay. Yeah. Thank you everyone. Have a nice day. Bye.